We saw that earnings were down by about 4% in the fourth quarter of 2022, expected to be down 6.5% in the first quarter of 23, which is soon to be reported. And then also taking a look at the second quarter, which is expected to be off by 6%, it just implies that we are moving ever closer to a recession.
The effects of a recession can be far-reaching, with job losses, reduced growth, and financial insecurity for individuals and businesses. As the economy contracts, struggling businesses may lay off workers and reduce consumer spending, further depressing economic activity. In today's video, Lyn Alden raises concerns about the Federal Reserve's dire financial situation, highlights the divergence between the stock market trend and broader economic indicators, and suggests that the United States may be heading towards an economic downturn. Stay informed about the latest developments in market trends by subscribing to our channel. Don't forget to hit the like button and share this video with your friends to help them to prepare for the upcoming economic challenges. First, Lyn explains why a recession is just part of a normal economic cycle.
It's normal for periods of excess to get wiped out, to take out businesses that are not really being productive. That frees people up, frees resources up to go do something more productive, figure out something new. And so that's completely normal. It also, wipes out bad debt from the system. The problem is that everything is so over levered now. And more importantly, leverage has gone up to the sovereign level. So what made 2008, for example, such a deep recession is that you had built up private sector debt for decades, and then that rolled over. A lot of that was then put onto the sovereign level. Basically, we somewhat delever the private sector. We put a lot of it onto the public sector. The problem now is that a lot of it's already on the public sector, and that tends to be a more inflationary scenario because they're still running. If you picture 2008. They were doing these like large rescue packages that were like $700 billion, whereas in the current environment, the deficits are like double that going forward on an annual basis. I mean, it's like the baseline deficit now is like 1.5 trillion. And to the extent that the Fed is eventually forced to resume monetizing it, which we might have partially seen over the past month with, they're still doing quantitative tightening, but now they're actually adding more liquidity into the system than they're taking out. And so if you get back to a period of monetized large fiscal deficits of that scale, in some ways that's like a stimulus. But the problem is that it's an inflationary stimulus. And so on one hand, you have contractions in, I am concerned about commercial real estate. I would not really want to be working in, a fund that finances office space, for example. I wouldn't want to be in an unprofitable tech company. There are certain areas that I think are quite vulnerable. But when you zoom out, that's somewhat balanced by the fact that they're just doing these ongoing deficits that are just pouring more money into the economy. And so that's why I think it's a more stagflationary type recession.
In March, Jerome Powell, the chair of the Federal Reserve, stated in prepared remarks before the Senate Banking Committee that the recent economic data has surpassed expectations, implying that the ultimate interest rates may exceed earlier estimates. Powell also expressed that efforts to bring the inflation rate down to the target rate of 2% will be a difficult and prolonged process. Interest rates of long-term bonds have fallen lower than those of short-term bonds, creating an inverted yield curve that usually portends an upcoming economic slowdown, said Andrew Sliman, head of the Applied Equity Advisors team for Morgan Stanley Investment Management, in a recent research note. Investors are now growing increasingly apprehensive about the possibility of a further downward trend in stock prices. The Fed boosted its target rate by 25 basis points to a range of 4.75% to 5%. The Federal Open Market Committee, or FOMC, noted that recent developments could lead to tighter credit conditions for households and businesses. As a result, there may be negative impacts on economic activity, employment, and inflation.
I certainly think you can see a period where, especially in inflation-adjusted terms, the major large cap indices just kind of chop around in a band for 5+ years, which is quite common, unfortunately, among global equity markets. The U.S. has been kind of an exception for the past 40 years. We've had among the strongest markets, but I think that trend is probably over, and now we're looking at more it depends on the stock you're in, depends on the sector you're in. But I think that the big indices are not in great shape. And another factor is that you can look at all these valuation metrics, but one of my favorite ones is to look at household allocation to different types of assets. And when the stock market peaked in late 2021, U.S. households had a record percentage of their assets in equities. And so there really wasn't a lot of marginal capital available to come in. And then when you look globally, countries had basically, both investors in the U.S. and investors outside of the U.S. were kind of like max overweight the U.S. And so we really have all got on one side of the boat. And so I think now that has some degree of time to unwind, and that's part of my thesis on why we're not going to probably see good equity returns in the U.S. for the next 5.
Cautious investors are expressing concerns that the recent market gains have left stocks at a higher risk of a potential economic downturn, especially with the recent chaos in the banking sector due to the collapse of Silicon Valley Bank. They're pointing out that equity valuations are still high compared to historical standards, and some believe that corporate earnings could significantly decline in the case of a recession. Hans Olsen, the chief investment officer at Fiduciary Trust Co., stated that the market isn't at all priced for a recession. This means that stocks could be in for some unpleasant shocks over the next few quarters. Lyn Alden explains how the Federal Reserve is facing a big challenge right now, and how if they're not careful, they could end up causing some serious inflation down the road, which would be bad news for just about everyone.
When people think of banks, the funny thing is that central banks actually work pretty similarly. They just have a few extremely important differences. So a normal commercial bank, you have assets and liabilities. And in an ideal scenario, the assets are higher yielding than the liabilities, so that the bank is earning a spread, right? So for example, deposits are lower yielding than mortgage loans in most cases. And so the bank is able to make a spread. A central bank works very similarly. So, they one is all physical currency is a direct liability of that country's central bank in the current era. There were periods of time like in free bank history where banknotes would be issued by a specific commercial bank, but in the modern era, most banknotes are issued by central banks. So, dollars are liabilities of the Fed. Also, banks store their cash at the Fed, and they earn interest on it. So that, those are bank reserves. And then there's also reverse repos, which is a little bit more complicated. But the point is they're also a liability of the Fed and they pay interest. So the Fed has these liability sides. And what made this cycle different is that because they raised interest rates so sharply from the zero bound, for the first time in modern history, the Fed's liabilities are higher yielding than their assets. So, what they pay on reserves and what they pay on reverse repos is, they're paying out more interest than they're getting on their very low yielding treasuries and mortgage-backed securities. So they're operating at a loss. They're no longer paying money to the treasury. And, I think moreover, it shows what other banks would look like if they were to raise their deposit rates to the level we see in money markets and T-bills. If you were to see banks around the country raise their interest rates to 3, 4, or 5%, many of them would have a similar operating loss and start eating into their capital like the Federal Reserve has. The main difference between the Fed and a commercial bank is that nobody can do a direct run on the Federal Reserve. So they're not prone to the same types of things that Silicon Valley Bank was. But the funny thing is the Federal Reserve has about $1 trillion worth of unrealized losses while operating at a loss. So it's actually if it were a bank, it would be bankrupt. But because of just its own operating thing, it's still able to operate, and it just kind of shows the crazy times that we're in. And if the Fed is unable to maintain tight monetary policy while you have above target inflation, then they risk getting longer term runaway inflation. And so I actually think that's going to be a recurring issue this decade. I think that's the big theme, is that because of how much debt's in the system, they're going to be unable to get to a period of structurally positive real yields.
Some people are hopeful that current households and businesses won't have to go through the same hardships that their predecessors did during the inflation and disinflation period of 1970 to 1985. However, as recession fears returned to the market, investors may no longer see bad news on the economy as good news. Stocks have gained so far this year after a tough 2022. The Dow Jones Industrial Average has gained 1% year to date, while the S&P 500 was up 6.9% over the same period. But all gains may be lost, as we fear that we're going down the path of 2022, or even worse this year. But what about you guys? What do you think will happen to the economy for the rest of the year? Let us know your thoughts in the comment section below. Be sure to like this video if you found it helpful or informative, and of course, be sure to subscribe to the channel. We'll see you in the next one.